Thanks very much for coming to the London Financial Regulation Seminar. We're very pleased to have Kevin James, who is a regular at the seminar, so needs no introduction. He's an economist at LSE Systemic Risk Center. He also has a newly found collaboration with the Indian financial authorities. He has written a very interesting opinion piece on how we should reboot the UK economy by having better financial regulation. And today he'll talk about that and more in City or Industry Take 2. Kevin, I leave the floor to you. Thanks very much for coming.
Thank you. Thank you for inviting me. So this is my first in-person seminar in like 2 years or something. So it's exciting to be an actual audience. So so it's gonna be, so my talk is City or Industry T2. And it's based on 2 papers, sort of more detailed economics paper by myself, Akshay Kotak and Dimitri Shimokos, about sort of how about the economics of productivity growth. And then that's sort of the fundamental economics. Then there's a policy piece that I wrote with Annamika here, who's a lawyer at the Indian regulator SEBI, and about sort of how we would actually implement this set of ideas in practice in an actual regulatory system. So I'll cover both of those things during this talk. Okay, so the choice the UK is facing is, should we have a city-based financial strategy or an industry-based, or I mean a real economy-based financial strategy? By permanently disrupting the UK's trading relationship with its largest trading partner, Brexit all by itself, definitely reduces both the level and growth rate of UK GDP. Okay, so if you just have Brexit and then do nothing else, right, the UK is definitely going to be worse off. So to make Brexit a success, the government must exploit the legal and just as importantly, the intellectual freedom that being free of the EU policy-making machine creates to devise new policies that will provide the foundation for a more dynamic, stable, and prosperous economy going forward. Financial services are going to play a critical role in determining the success of the UK's post-Brexit economy, obviously. Okay? And the Treasury, HMT, is now engaged in a wide-ranging review of the UK's regulatory framework. And so the choice the Treasury has basically is to go down one of 2 paths. They can take a city-focused strategy, which will aim to make the UK or London, the world's leading international financial center, or IFC. Or they can take what I'm going to argue for, an industry-focused strategy that aims to create effective financial markets for the real economy. The city strategy has been outlined by one of the city's sort of leading trade groups called the City UK, which is like an umbrella group that sort of brings together a whole bunch of different city lobbying organizations. So they put out a paper recently called "Making the UK the Leading Global Financial Center." Okay. And so their strategy is just that, right? What can the government do to sort of make London once again be the world's leading financial center? This strategy would be great for financial firms, obviously. Which is why the City UK is pushing it. It also has positive spin-offs for the real economy, of course, so it doesn't make us worse off, but it's not really emphasizing the real economy side. In their perspective, the goal of regulatory policy should focus upon the competitiveness of the city, right? So if you want to make the city the #1 financial center in the world, right, then you think about how is regulation affecting the UK's ability to be that leading financial center. Okay, so policymakers should consider how their proposals might affect the UK's competitiveness and give due weight to the answer when conducting their analysis, right? So it's a very city-focused strategy. How can the regulatory system help the city achieve this crown of being the world's leading financial center? And one of the ways to become the world's leading financial center is to grow the UK's share of key global financial markets. So focus on tier 1 developing markets, which provide the most commercial promise, including China, India, Indonesia, South Arabia, and Russia. Okay. The pitfalls of that strategy are the following, really. First off, it has a financial sector rather than a real economy focus. Maximizing the benefits of the financial services sector is not the same thing as maximizing the social benefits that financial services create for the whole economy, right? And so you think about the financial sector very narrowly. The main role the financial sector plays is helping the rest of the economy work well. So if you focus on just maximizing the profits of the financial services sector, right, then you're not really doing the most you can for the real economy. Second, a competitiveness objective creates enormous regulatory risk. Enormous regulatory risk. There's a fantastic paper, which anybody interested in financial regulation or banking policy should read, by Patrick Conaghan, who was the governor of the Central Bank of Ireland in 2008, about the Irish banking crisis, regulatory and financial stability policy, about how exactly the Irish financial crisis happened. Okay? And so one of his observations is that deference and diffidence on the part of the Central Bank of Ireland led to insufficient decisive action there was an unresolved anxiety that an aggressive stance would lead to a loss of market share by Irish-controlled institutions. So in Ireland, they did have a competitive objective. One of the objectives of the central bank was to promote the competitiveness of the Irish financial sector. So whenever the regulator wanted to go to the banks and say, you guys are taking too much risk, it would say, but you're going to hurt our competitiveness position relative to other banks in the world. Okay? And because the risks are always kind of, in the future and kind of vague and nebulous, like there might be a financial crisis sometime, but the hit the profits are like right now. Like if you do this right now, we're going to lose money, right? The sort of, hit the profits always won the debate. And so Ireland, so even though people foresaw that there was going to be this problem in 2003, 2004, right? It was impossible for the central bank to actually bring itself to do anything, in part because of this competitive objective. So if the UK has this objective as well, it'll be extremely hard for the regulators to sort of take any kind of decisive action against the banks when they're going crazy, right? So this idea of having like this, that the regulators should focus upon competitiveness is just totally insane. And last, focusing upon China and Russia for growth really creates geopolitical risks. Financial firms that expose themselves to China or Russia give the Chinese or the Russians leverage over them that those hostile regimes can exploit to advance their regime interests, which do not align with those of the UK. And so it'd be nice if people like investing in China, Russia. So people who invest in China, Russia know the score, right? So they know that if your business hinges upon what the CCP thinks of you, then you have to sort of do what the CCP says, basically, right? And so it's going to create a sort of very powerful lobbying group in the UK that's going to be working for a hostile foreign power, right? So that's sort of that's a big downside. Okay. Now, I'm not really singling out the city here. The academia, where we work, right, is also massively compromised by Chinese money. So it's not like the city is singularly evil or something like that. But it's basically if we do more, if the UK focuses more on, having a key sector depend upon China and Russia, it's just going to make the problem worse rather than better. Okay, so what's the alternative? The alternative is a financial market effectiveness strategy. I think the core idea here is that better markets are better than bigger markets. So you don't want to have like the biggest markets, or you want to have the markets that work the best. The indirect contribution that financial markets make to economic performance by enhancing growth and stability of the whole economy is their most important contribution to the overall economic welfare. So it's not their profits all by themselves that really matter, it's how well they make the rest of the economy work. That's the key thing, and that's what regulation should focus upon. Second, a dynamic, stable, and innovative economy that effective markets can help bring about provide an excellent foundation for the UK's post-Brexit experience. So if the UK economy is doing well, right, then whatever happens in the post-Brexit world, the UK will be in better shape. And last, the cost of this sort of regulatory moonshot aimed at producing effective financial markets is like rounding error on the cost of other things that governments think of doing to enhance growth. Right. So one option is like increase R&D spending by some non-trivial amount. R&D spending is like what, 50 billion pounds per year or something like that. So you increase that by 10%, you're talking 5 billion pounds per year. Right. The cost of hiring me and a couple other people to write a study on how to make markets more efficient is like tiny relative to that comparison. Right. Okay. And so basically the cost of this is really, really tiny. Okay. And potential benefits are really, really enormous. Okay, so that's the big picture. So let me first persuade you that financial markets really do affect economic performance. Here's the intuition for what's going on, why financial markets matter. Say you have a firm, and a firm's going to choose a strategy to develop some project. They want to do something. Okay. The value of the project depends upon two things: the value that the project has given as a success, and the probability of its being successful. To be a success, a firm has to convince the market that it has a good project at some intermediate point. So you have this idea, you have to convince the market that you have a good project to get some funding or some employees or some customers, whatever it is, right? And then somewhere down the road, you have a successful product or not. Okay. Now, so a firm can pursue one of two strategies really. Go to a substance strategy that aims to maximize the value of the project, given that you're successful. So you think about, we'll make the best thing we can, whatever it is. Okay. Or you can pursue a quick win strategy that says we're going to signal to the market that we have a successful project by doing something very short term, not very innovative, maybe, okay, but at least we'll tell people that we have some worthwhile project, early on. Okay. When markets work well, the market can more accurately assess project quality, and so the benefit of this quick win strategy declines. So if you don't have to do a quick win to show that you're going to be successful, because the market can tell already from better accounting information or better disclosures or whatever. Okay. And so when markets work well, more firms pursue innovations. So effective markets therefore lead to more innovation, and to higher TFP growth and better financial stability. Because when the economy is more productive and you have a credit boom, which is the big risk of financial stability, then it's more likely that credit boom is financing productive investments rather than some crazy speculative thing. Okay. Now, that sounds kind of abstract, but let me give you a really practical example that will at least be relevant for those of us who are thinking about academics. So let's think about scientists. They face the same problem. The scientists want to do innovative work, but they also need to convince the market they are capable of doing good work first, right? They need to get a job, they need to get a grant, something like that, right? Okay, so you have these two strategies. You can say, I'm going to do something really fantastic, which has this payoff down here, if I can persuade somebody to give me a job first. Or you say, I'm going to do something really boring, but I'll get like citations now, and then I'll get a job, right? Okay, so we this is obviously, if you're thinking about going to academics, right? This is a problem that you personally will face. Okay, and so so scientists can pursue either the substance strategy and said, I'm going to shoot for the moon and do some innovative work, or a flash strategy, which is I'm going to do sort of really incremental work that gets some citations. Okay, over time, scientists have switched from doing this sort of substance strategy to this flash strategy. And this has led to a significant decline in scientific innovation. And so one reason we have more scientists now, but less innovation, is because scientists are pursuing this sort of flash strategy, right? They're doing really incremental, sort of boring stuff, aiming at citations, because you need to get the citations to get the job. If you don't get a job, you can't do the innovative science, right? That's exactly the same phenomenon I think happens with firms. So in a market where firms focus on doing these sort of very incremental, quick win projects, you don't really get the big innovations that you would have had in the past. Right? That really affects the economy's overall ability to sort of do innovative activity. So if we have a market that works well, then we can sort of get firms thinking about these longer term projects, and that will lead to more innovation. That's the prediction. That's if you're interested in science, that's quite an interesting paper there that by Acharya and Paklan, actually documenting how science has changed over time. Okay, so we take this idea and we look at the U.S. economy from 1850 to 2020, so 170 years of data, and we develop a measure of innovativity, which is basically 1 minus the standard deviation of idiosyncratic firm returns. The intuition there is pretty straightforward. When firms are pursuing these short-term strategies, then they're producing lots of signals, and produce lots of signals to mean the firm's price bounces around. And the more the prices are bouncing around, the higher the standard deviation returns. Okay, that's the intuition. So the paper we go through 20 pages of math in the paper. You can, so if you're interested, I can send you the paper. Okay, and so based upon this analysis, we identified for this entire 1850 to 2020 period. There are actually three market effectiveness regimes in the United States. Before the Second World War, the U.S. was in a low effectiveness. Markets were of low effectiveness. You had a peak period of high effectiveness from like 1946 to 1969, sort of this peak period. Okay. And then since 1980, things have once again been low effectiveness. Okay. So, and what happens, do I actually see this on the screen? Right. Okay. So if you're thinking about financial regulation, what happens, right? So in this period here, the pre-war period, there's essentially no financial regulation in the United States, right? There's basically nothing. Right? There are some sort of state laws. But the Investment Banking Association wrote to a bunch of bankers in 1915 and said, you can ignore the state laws, because in the US, if you would do a transaction across state lines in the mail, then the state laws didn't affect you, right? The state laws only matter if you did something in state. So you can get around all the laws that were around by just using the mail. Okay, so basically everybody got around laws. Okay? So in the pre-war period, there's basically no rules. Okay, and so you had ineffective markets, as our theory would predict. Okay? During the 1930s, you had this wave of financial market regulatory reforms, right? You had the SEC, reformed the 1933 and 1934 and 1940 Acts, and you had the reform of the Federal Reserve, you had all kinds of stuff going on, right? Which led to a massive increase in financial market effectiveness, right? So as regulation improved market effectiveness, then then the markets actually got better, and then since the 1970s or something, I think our conjecture is that the market has evolved faster than the rules can keep up. Okay? And so over time, the rules are still there, but they're not as effective as they were in the past. It's sort of like, the market has developed an immunity to the sort of financial regulation drug. Okay? And now we're back to where we were before the SEC was even around. Right? So financial markets, so even though people still file their regulatory reforms and all that sort of stuff, the efficacy of the rules has really declined. Because now people can just, either the rules haven't kept up, or people have found ways around the rules. Whatever it is, the markets are now ineffective, just as they were in the pre-SEC period. Okay, so now our prediction for our analysis is that total factory productivity growth will sort of will follow market effectiveness, and that's exactly what we find. Okay. And so before in the pre-war period, TFP growth is about 1% per year, and in the post-AD period, it's about 0.8% per year, and those are not statistically significantly different. Okay. And then but in this period here of peak markets, of peak effective markets, right after the financial market reforms, TFP growth is 1.87%, which is significantly higher. And so you have this massive productivity boom that accompanies kind of effective financial markets. You see the same thing with financial crises. So in the pre-war period, when markets are ineffective, you have one crisis every 12 years. Okay. In the post-AD period, when markets are ineffective, you have one crisis every 13 years. Like, so exactly the same. Right? And in this middle period of effective markets, you have no crises at all. Right? There's a very small probability you would get through that sort of peak period without a crisis if the probability of a crisis was the same. So basically, it looks like the probability of a crisis was much lower during this period when markets work well than when markets work poorly. And that's another implication of our analysis. Okay, so when markets work well, you have high productivity growth and stable markets, which is kind of the everything you could possibly want from the financial sector side. So the bottom line is that market effectiveness really matters. Effective financial markets provide the foundation for an innovative economy. An innovative economy leads to higher productivity growth, and innovative economy is also more stable. Because when financial markets work well, credit booms are an opportunity rather than a risk. So usually you think about credit booms as this big risk, right? That's only when people are doing crazy stuff with the money. People are doing something intelligent with the money by investing in innovative projects, right? Then credit booms are fantastic. Okay. And so fundamentally, there doesn't really need to be a trade-off between growth and stability, even though the way we do practical regulatory policy now, there is this growth stability trade-off. Because if you think about the way financial stability policy works, basically the goal of macroprudential policy is to hammer on credit booms. Okay. So when credit booms are high, there's substantial risk, right? And so the central bank will sort of somehow restrict credit, you'll make banks hold higher capital ratios or otherwise penalize banks for lending. Okay. And so you want to constrain credit booms. Okay. And constraining credit booms does reduce the risk of a crisis, but you also reduce growth because the growth happens during credit booms when people take money and do something innovative with it. Okay. And so the way we do policy now, there is a real trade-off between growth and stability, but that policy doesn't have to be there. If you think about making markets work better, you get more growth and more stability at the same time. Okay. So the central goal of financial regulation should be to make financial markets effective from the perspective of the real economy. That's our bottom line. And so the question is then, how can we do that? Okay. So I should have said this at the beginning, but if you have questions, feel free to ask them during or there'll be time at the end as well, but you can ask also during the talk. Okay, so to implement the market effectiveness strategy, we think there are three reforms or three major avenues of reform that the UK would need to implement. First off, regulators will need a new mandate, right? We'll need to have the people focus on making markets effective from the perspective of the real economy. That should be an explicit goal of the regulatory system. Second, we'll need a new approach. So regulators will need to work with information that regulators can in practice, collect and analyze. So I'm calling this an information consistent regulation. So as I'll talk about in a second, so now we have a lot of policies, we don't actually have the information we need to know if those policies are working. So it's kind of crazy to have the policies if we have no way to know if they actually make sense. And I draw upon a presentation by Peter Andrews here that we presented at a conference I organized recently on this theme. Then we also need new accountability arrangements. So the HMT and Parliament and the Treasury Select Committee must hold regulators to account for the market outcomes that their actions create, not specific policies. So can we go through these one at a time? So the problem with market effectiveness now is that no regulator is responsible for the overall effectiveness of the financial system. So the FCA focuses mostly upon consumer protection and does think a little bit on market effectiveness. Bank of England focuses mostly on financial stability. It does a little bit on market effectiveness, but nobody actually says we want to make financial markets work well for the perspective of the real economy. So there's a market effectiveness underlap. So just like before the 2008 financial crisis, there was a financial stability underlap, right? So in one of the findings of the analysis of the financial crisis in the UK was that there is no regulator who was responsible for the overall financial stability of the financial system. And so one of the reforms following the 2008 crisis was the creation of the Financial Policy Committee at the Bank of England, which had this goal of thinking about financial stability from a system-wide perspective. We basically need something like that, but from the market effectiveness side, because now there's nobody who actually thinks about financial market effectiveness from this overall perspective. And since somebody's thinking about it, like nobody's actually trying to make it happen. Now, that's going to be a big challenge though, because the UK is not really set up to, neither regulator is set up to do this. So the FCA almost has the right mandate, but has totally the wrong mindset. If you think about the FCA now, their mandate is to make markets work well. So that's because that was kind of a promising start. If we think about what they actually do in practice, they focus upon risk to status quo, which is people breaking the rules. Okay, so you have this sort of status quo, and the main thing is to think, what rules are people breaking? How can we stop that from happening? So the approach then is very data-driven. You want to find people who are breaking the rules, and so maybe putting systems in place to find people breaking rules, that sort of thing. And so the requirement to make that approach work is data processing capabilities. And so you focus very much on sort of collecting a whole bunch of random data. The success then is market participants follow the rules, is what they're aiming to accomplish. So if you look through the FCA's latest business plan, you see a big emphasis on data processing capabilities, a big emphasis on being data driven and that sort of thing. Excuse me. Okay. And so it's very much like a status quo policy. If you think about effective financial markets, right? The problem is the status quo. The problem is status quo is not good enough, right? So it's not that we don't want to worry about is there a risk to status quo, but say basically we should be the risk to status quo, right? The status quo is not particularly good. Okay. Now, and there is no amount of data that will tell you if the markets could be better than they are, right? There's nothing you can look at in the market and say, could the market work better, right? You can't look at any piece of raw data that will tell you that information, right? So you need to actually think about, you need to have a more analytical approach. It has to be much more research driven. You have to think about how can we identify or exploit opportunities to improve markets as they are now. Okay. And that requires analytical depth, where you need people in the organization who actually sort of analyze markets and think about what's going on there. And so you can think about how you can make them work better. Okay. The FCA doesn't really do that at all. Okay. And then the success so if you approach regulation this way, success is having the right rules in place that people follow, not that people follow the rules first. Right? The question is, do we have the right rules, and how can we get those rules, or what are the right rules, basically? Okay. So it's an entirely different mindset from the way the FCA is actually currently approaching its obligations. And so to make the FCA kind of a market effectiveness regulator, we require a massive, cultural change in the organization. It's not fair they could actually do that. Okay. So even though they're in theory kind of the right regulator to take on this market effectiveness role, kind of in practice they're not really capable of doing it. So as I resigned from the FCA, in June, so in part because of this project, right? And so I'm speaking from bitter experience here, right? So it is. So I really don't think that they are the right organization to do this. Now, the Bank of England kind of has the wrong mandate, right? But in theory, it has much more of the right mindset. But there's some issues there as well. So the Bank of England does have a much more research-oriented approach and much greater analytical depth than the FCA. And so with a bit of work, it could pursue a market effectiveness objective. So just as an organization, you think about what is the sort of analytical capabilities of the group, right? They can actually maybe understand or analyze market effectiveness much more effectively than the FCA could. But the Bank of England's current mandate and legal powers do not enable it to do so, right? So the Bank of England just doesn't have authority to regulate financial markets, capital markets very much. They can regulate them from a stability perspective. So there's a risk of stability, they can sort of intervene. But if there's a risk of effectiveness, that's not their job, right? They don't really have legal powers to sort of regulate that aspect of financial markets. And so to have the Bank of England pursue a market effectiveness objective, we would need to expand the bank's mandate and legal powers to include these much broader remit to cover financial market effectiveness. So there are two issues with that. The first one is that would make the bank even more powerful than it already is. It's already this super institution with an enormous amount of power over broad aspects of the UK economy. Because if you add this as well, then you're making it an even more powerful organization. Second, this would really place enormous demands on bank senior management. So you think about the top of the bank, you have like the governor and a couple of deputy governors, right? What are they in charge of now? Right? They have to be responsible for macroeconomics, financial stability, banking supervision, market operations. These are all very complex, independent areas of knowledge, right? And so if you add on like, financial market effectiveness as well, and you have the same kind of like, 10 people at the top of the bank, right? It really places enormous demands on those guys to have this incredible amount of knowledge about all these different aspects of financial economics. And so it'd be quite demanding to add on kind of another complex remit to the bank's already existing very broad sweep of areas of responsibility. So unfortunately, there's not any really particularly easy answer to how to go about adding an effectiveness objective to the UK regulatory system. So the current arrangements, so tinkering with the current arrangements probably aren't going to work for the reasons we've just discussed, right? The FCA has the right mandate, but it's the wrong place, right? The bank is maybe the right place, but it doesn't maybe have the room to add this objective as well. Okay. So maybe you can think about a new regulator or a new organization that focuses on effectiveness, but how would that fit into the existing framework? I don't know. So the question needs further analysis. I mean, how you'd actually do this is a tricky problem. And at the moment, we're just saying that it's really important, right? And we should find an answer, but I don't have an answer on hand. So I'm not sure what the actual best way of doing this is yet. Okay. The second point I would raise is that we need a new approach to thinking about like how we approach regulation. Right? So basically, flying blind is like no way to regulate. Right? So now regulators collect a lot of information, but much of it is not clearly related to what regulators are trying to do. And in some cases, the data that regulators need to successfully implement the regime, the rules they have, is not collected and does not exist. Right? So you have this regulatory objective, but there's no way to actually accomplish it. And so it's kind of crazy to have it there. Okay? For example, consider conduct regulation. This is like retail investor conduct regulation. So poor conduct manifests itself in the form of investors purchasing unsuitable products and or products with a poor price performance relationship, right? So that's basically what. And so as a regulator, you're thinking about conduct, you want to avoid both of those things. You want people to buy suitable products. You want the products people buy to have some sort of good price performance relationship, so not like totally ripped off. Okay. But the FCA does not actually track either suitability or the price performance characteristics of retail financial products. So mortgages are a partial exception, but they don't, and they track for some limited extent they look at mortgages. Okay. And so now, you're thinking about suitability is the foundation of UK consumer protection law, where people are supposed to, financial advisors are supposed to sell suitable products to people and make sure that they're that everything they buy is suitable. Okay. But there's no way to measure suitability, right? You just can't measure suitability. Okay. And we don't collect any data on like are people actually behaving this, are actually people actually selling suitable products. Right? And so you have this obligation in the regulation, sell suitable products, but there's no way to actually measure if that's happening or to enforce it. Okay, so you have this regime that depends upon something we can't actually, effectively measure. So it's kind of crazy. So it's no surprise that the UK has had so many financial regulatory disasters because you can't really police suitability, which is at the core of the system, in advance. And suitability, the same problem applies to this price performance relationship. So we don't really track. The FCA does not track the price performance characteristics of the financial products that are available. So we can't really say, are our products becoming better on average over time or not? We have no idea, basically. Right? And so you have this regulatory system, and this is like one of the things you're trying to do, but you can't see it and you can't measure it, and you're not targeting it, and you don't know if the regulatory system is actually working. So it's kind of a crazy, we're in a crazy place. Right? And so what the FCA does instead is track very, very indirect measures of conduct, such as risks, compliance infractions, a state of firm systems and controls that are easy to measure. But the things that are easy to measure are not really relevant to what we're trying to accomplish, right? And so it's no surprise that we had this long line of regulatory disasters, right? Because you don't really have this very tight connection between the data you have and what you're trying to accomplish, right? And so what we really need is an information consistent regulation. So, or I think as the English saying has it, right? The regulator needs to cut their regulatory strategy according to their data cloth, right? So if you're putting into place some policy right? Then you should be required to sort of say, what information do you actually need to implement this policy successfully? And can we collect that information, right? That's basically what you should have to do before you put a new rule into place or a new regulatory strategy. And so if you can't do that, and if you say we have this ideal strategy that will work really well in a perfect world, right? You think how will it actually work in this world, right? That's kind of the real world question. Right? And there's no way to get it to work, like in practically get it to work because you can't collect the information you need, right? Then you need a different strategy or a different policy. That's basically it. Right? So you need this. So by information consistency, I mean the policies you need have to mesh with the data you have, right? And so that they need to work. And if you don't have the data, then you need a different policy. So for example, it may be impossible to measure the price performance characteristics of retail products due to the wide variety of products on offer. So if you let people, so now you can basically offer almost any kind of product, right? As long as you sort of meet these different requirements. And so the range and the variety of products on offer is just enormously big. And so it's very hard to keep track of what's going on because you have all this variety and all these different features and all that kind of stuff. Right? So it's very hard to sort of compare. Like if you think about like a mortgage or something, there are like all these 8 zillion different like characteristics of the mortgage, and you have to compare all these different mortgages together at one time. It's very hard to think about how you compare different features. These products, they try and do the same thing, but have these very vastly different features. So is this one better than this? Is mortgage A better than mortgage B? No, unless you can actually value all these different characteristics, it's quite hard to tell. Right? But if you can't value these things, then you can't really know if their regulatory regime is working. And so if the products are too complex to sort of evaluate, then maybe the regulator should consider imposing product standards that limit the variety, right? And then you can have more effective regulation. So if you have standardized products along certain key dimensions in some ways, right? And then you can actually track how well those markets are performing, right? And so, which is one way of reducing. So having some product standards is one way of reducing the product complexity that makes it impossible to monitor suitability. But basically, if you have some sort of suitability type requirement, then you really need to have some way of tracking suitability in practice. And so you need, and I'm talking about suitability here, but that problem applies sort of to all aspects of financial market regulation. So if you can't actually track what you're doing, then you're not going to do a good job, right? So you need to have this sort of consistency between your policy and your data. Okay. And the last thing you need is new accountability arrangements. So the current accountability arrangements are the following. So the Treasury and the Treasury Select Committee hold regulators to account via informal but regular consultation on what the regulators are up to, underpinned by a series of formal have regards that regulators must take into account when acting. And so the Treasury has a list of these things you have to do, like do a CBA analysis, use your resources economically. They have like a long range of things. And that's how basically the Treasury tries to make sure that regulators sort of do the right thing. Have regards are an extremely clumsy and ineffective way of guiding regulators to do the right thing, though. Policy making is very complex. And so the Treasury has this very long list of things regulators have to take account of when they're regulating. But those can lead to very confusing and conflicting decision-making criteria. So the PRA, for example, the bank regulator, the banking supervisor, must have regard to over 20 different factors when making policy. So imagine you're trying to make this policy, but these 20 different criteria are trying to maximize in some way, and these different criteria are conflicting, and kind of confusing. And so how do you make a policy that tries to satisfy all these 20 different weird criteria? So it's kind of a bit crazy, right? And so trying to constrain the regulators via have regards, it's really ineffective. But you can see the Treasury does this because they think, what else can we do? Right? So they feel kind of stuck. So they don't want the regulators totally out of control. So they give them this long list of have regards, but the have regards are a super clumsy way of trying to constrain them to make them do the right thing. Okay. The critical problem is that the consultation requirements and the have regards apply only at the policy level. What we actually care about is market outcomes, which arise from a web of policies and regulatory practices. Okay. And so accountability really applies to the wrong thing. Okay. So if you think about some market outcome that we care about, right? It's going to be due to a combination of different policies and supervisory practices and sort of regulatory guidance and all kinds of different things. They're all going to mesh together to form kind of the market outcome. Okay. And so if you think about does policy A kind of make sense in isolation? that's not going to tell you if the market outcome is like the right market outcome. Because you think about holding everything else constant, like if we is policy A kind of okay. Well, okay, I mean, maybe it's kind of okay all by itself, but does it like work well with policy B? Does the combination of things get to the right market outcome? You can't really tell that by looking at one policy, each policy one at a time. Right. And so even if you consult on the policy, you ask you ask for market feedback on policy A. So what do you guys think? So we do a consultation document on policy A. We ask the market participants, what do you guys think about policy A? They say these various things, but it's not kind of getting to the market outcome itself, because you really want to say, what do you really think about like all these things kind of together? And how can we devise the right mesh of policies and practices to sort of produce the right market outcomes? And in that regards, you might do a cost benefit analysis on policy A, and maybe policy A is like, kind of makes sense all by itself, but maybe policy A and policy B together do not make very much sense, right? But you want to capture that by doing a cost benefit analysis of policy A, right? Because when you do a CBA, you sort of look at your one policy and hold everything else constant, right? And so the point of regulation is that you really shouldn't hold everything else constant. You should try to devise this sort of combination of things that are going to work well, right? And so the whole individual policy focus is just wrong, right? Just the wrong level of trying to hold regulators to account. Okay, so so the alternative is you want accountability at the outcome level. You want to say, okay, regulators are responsible for producing good market outcomes, right? And so you want them to explain how are they going to get the market outcomes that they want through a combination of policies and practices. Okay. And so what regulators should really, what the Treasury and the Treasury Select Committee should really ask the FCA is, what is your strategy to achieve, these market outcomes? What market outcome do you want, and how are you going to get there? So going back to our suitability example, what you want the Treasury to ask the FCA is the following questions like this: what is your overall plan to ensure that investors invest in suitable products? What research or consumer trials have you undertaken to suggest that this plan will actually work? How will you measure suitability and track portion of investors with suitable products over time? How will you know if your plan is working? Would you have some sort of ex post reviews designed, or how are you actually going to know if you're going down the right path, or are you going to need a different combination of policies to get this thing to work, right? And so you want to have this sort of higher level discussion, focusing upon market outcomes, not looking at like each policy one at a time. Now, to do that, that would impose like much higher demands on the Treasury than are currently the case. Because now the Treasury, you talk about these different policies, you don't really have to have like a big picture in-depth conversation about how the regulatory system is working, right? And so, but if you go to this sort of more in-depth type of consultation that I'm advocating here, the Treasury and the Treasury Select Committee would really need to enhance their ability to engage with regulators to make this work. Right? They would have to have much more depth and knowledge than they do currently to sort of hold regulators to account. But if you think about the UK experience, which has really been a long series of regulatory disasters, this long series of regulatory disasters really shows that systems that's not going to work properly as the government can hold the regulators to account, because the regulators exercise these really vast delegated powers on their behalf. So if you have these regulators exercising these vast powers, you can't hold them properly to account, right? Then you don't get a system that works very well. Right? And so I think that the Treasury really has to sort of up their game on the accountability side. By developing more in-house skills, they can have these more in-depth conversations with the regulators about how they're trying to accomplish, key market objectives. Okay. So basically, if you think about where we are now, I think our situation calls for bold, persistent experimentation. Continuing slow productivity growth and/or another major financial crisis will be an economic, political, and social catastrophe for the UK. We will need to solve this low innovation problem, now. So sure, we can round up the usual suspects of increasing R&D spending, incentivizing people to pursue STEM subjects, and all that, like we usually do. This will cost like billions of pounds and may not do very much good because, the market effectiveness is, ineffective markets are really the key problem, not a lack of R&D. So if you look at that, if you look at the US, you think, what's actually the problem with, productivity growth? Here we are. Okay, so the yellow line here is this line. So this line is R&D spending divided by GDP. Right? So you can sort of see that it's been trending up, while actual productivity growth has been going down. Right? The reason productivity growth has been going down is because markets are becoming less effective. Right? And so the real problem isn't that we're not spending enough on R&D, we're spending tons of money on R&D. It's like, 2.5% of the economy or 3% of the economy, whatever it is. Okay, they're spending a ton of money on R&D, but when markets are ineffective and firms pursuing these short-run strategies, then R&D isn't doing very much good because people are still using R&D to pursue these short-run, quick-win strategies rather than real innovation. So you're not really going to get the benefits of this R&D spending unless the markets work better and people focus on these longer-run kind of innovative projects. Right? Okay. And so spending more money on R&D when markets are ineffective is not going to solve our problem. In our view, right? So, okay, we could be wrong, but I think that's probably the case. Right? And so instead of spending another 10 billion pounds a year on R&D or something, or before we spend another 10 billion pounds a year on R&D, right, we should also spend, like I said, this tiny amount of money to think about how we can get markets to work well. Right? That's basically it. Okay? And so this, if you want to see what the standard answer to increasing, growth is, you can look at this paper by Bloom, Van Meenen, and Williams. Right? So. And they talk about, like I said, R&D and STEM subjects, all the standard stuff that you know about already. Okay. So we're saying, so do all the standard stuff, spend your, whatever billions of pounds on that sort of stuff, right? But spend a little tiny bit of money, right? On thinking about how we can make, financial markets work better. Okay. So this will not cost very much relative, it will cost basically nothing relative to these other types of activities. And the upside here is really enormous, right? The UK really is facing quite a momentous decision. I said, if you don't solve this low innovation problem, then Brexit's going to turn out to be a disaster, and the UK is going to be facing pretty dismal, several decades of economic performance. Right? And so that would be really a total disaster for the country. Okay? And so doing something to solve this problem is really important. And I think that pursuing effective financial markets has to be like one of the most sensible things you could try to do to solve this problem. Right. So that's it. So thank you.
Are there any questions from the audience? Anybody want to say yes?
Hello, thank you for the beautiful presentation. I think it was really fruitful. When we have this class with Professor Lastra on regulation of financial markets, and she could not better emphasize the independence of central banks in terms of financial stability. But when we're talking market effectiveness, since it's a parameter since it's a factor that contributes to the the development of a country, do you think if we have a new mandate for market effectiveness, it should be independent, or should it be somehow linked to the political, the Ministry of, the Treasury, or should it be under the political ruling regime, or should we really ensure its independence?
Yeah, so that's a tricky. Yes, I've been thinking about how to do this, and so maybe ideally it would be independent. Maybe it'd be like something like the Financial Policy Committee, but aimed at market effectiveness. So you have the Financial Policy Committee is at the bank, at the central bank, but has authority over different for in their remit. They have authority over different regulators. Even though the FPC is at the Bank of England, right, they can direct the FCA to act in certain ways if it affects financial stability. Right, so they have a lot. So they have a lot of power in their remit. So maybe they need something like that. Which would also have equivalent for financial market effectiveness. So they have some regulator would be in charge of financial market effectiveness, and then it would direct, the Bank of England or the FCA to act in various ways to promote effectiveness as an independent. So it'd be like an independent regulatory body that could sit maybe at the Bank of England or at the FCA or somewhere. So I think that might be the best way to do it. And then have it because then you wouldn't need to build your own separate regulator to do the rules, because the FCA can already do that basically. So basically you just need to tell the FCA kind of how to act a bit differently, right? That's so maybe the sort of independent kind of regulatory body would be the best way. Because the problem with doing that, the Treasury really doesn't have so I guess the UK civil service, people rotate jobs all the time. They don't really develop a set of core specialist expertise in the UK Treasury, because people rotate jobs all the time. So you wouldn't really have the staff. It's not really set up to do this long-term kind of project, like promote effective markets. Right? And so doing it at the government level would be really hard in the UK. So maybe in other governments where you have people sort of will specialize in something for a long time, maybe you could do it in a government agency instead. But for the UK, for sure, I think you would definitely need to do it as a separate regulator, sort of independent regulator, which would be specialized in just this task, and would have the staff and stuff who specialize in that. because it's really going to be very technical and require a lot of analysis and research.
My question is basically, in order to establish an independent regulator or be that government-led, the decision would still need to be effectively taken from top to bottom. So that would come from the government itself. And initially in your presentation, you said that there are groups such as the City UK, which acts like the financial institutions of within the United Kingdom, and they're focused on achieving a city strategy rather than an industry strategy. So, and this can be seen in the United States as well, like after Bill Clinton and all the deregulation happened once again. How would you convince these sort of lobbying groups to take a more industry-focused strategy? Because in order to affect any change that's happening within the system, you would first need that to go through Parliament and to create an independent regulator or a government-led regulator. So how would that change come through practically, and how would you convince financial institutions to take that industry-led strategy approach?
So it is. So in this struggle with the City UK, we are definitely overmatched in the sense that we can't wine and dine ministers, as we have zero budget, right, where they have this lobbying budget, an unlimited lobbying budget, which is unfortunate. So what we've been doing is we've been lobbying the Treasury basically. So we did this conference for the Treasury, and I send the Treasury these presentations, periodically, right? And so they're doing this review. The Treasury, it's called the Future Framework Review, where they're looking at the future of the regulatory system. And so we've been trying to just lobby them, analytically and trying to convince the Treasury that they have this. So our pitch is that the government has this objective to build back better and level up the economy, and so they have this kind of incentive to try and think about. In some sense, they're naturally predisposed toward thinking of an industry type strategy. They want to build up the economy, and they realize that the UK has this big problem with innovation and low productivity growth. And so our pitch is that we can help you solve this problem if you pursue this sort of strategy, right? And so that has been our goal. So now the City UK is also obviously lobbying for their bit, and said they have a much higher lobbying budget than we do. So so we'll see who wins. I don't know. But I'm hoping that by pitching it to advance the government's goals, we can get them interested in pursuing this approach. That's been our idea. So so we'll see. So it is. So my colleagues at the LZ kind of who also laugh at me for thinking that we're ever going to beat the city in this sort of lobbying, which maybe will happen. I don't know. So the other thing we're doing is that we're trying to we have this partnership now with the Indian financial regulator, SEBI. We're trying to pitch this idea to them to get them to think about making Indian financial markets work well, because they also have this issue where they're thinking about where economic growth is really important to them. And so in some sense, if we can get to sort of the economic growth idea and that's being really important, then we can get them to do the right thing, as the benefits are really high. So yes, that's basically the same idea. So if we can persuade them that from a social perspective, this is really massively good, and a lot of people think economic growth is important. So if we could provide that objective, maybe we can persuade them to go down this path. Yeah, but we'll see. So a couple of years. I guess that the Treasury should decide the next, sometime this year, early next year, what they're going to do. So so we'll see.
Good evening, and thank you for your presentation. For me, it was very important something that you mentioned, that the relationship between an efficient regulation and innovative economy. But what I do believe, and I want to draw an example from my country, is that regulators should not go on their own. There shouldn't be like rogue agents. It's really important to develop. This is a joint effort, I believe, and it's really important to develop private-public partnerships to achieve this. So what we did in Argentina, I worked on the financial intelligence unit. We had a situation with the banks regarding the quality of the SARS, and also the regulation for the bank specifically was outdated. So we developed a joint program with them, with the private sector, with the public sector and the private sector, to listen to them, listen to their opinion, and this really improved the quality, not the quantity, but the quality of the SARS. And also I believe that it helped to achieve a better financial regulation for this sector specifically. So my question would be, do you know, besides Gimlet, which I do know, other private-public partnerships ongoing, or what's your opinion on public partnerships to achieve this ideally financial efficient regulations?
You see, so there is a lot of just informal cooperation just through conferences on so there's like so a lot of interaction between sort of academics and city people in various conferences and seminars in London. And so I definitely agree with you that the city professionals have a lot of expertise that we definitely need to tap into to make the markets work better. So that you can't do this just sitting in your own sort of ivory tower without consulting with the markets. So when I was contrasting sort of our strategy with the city strategy, it wasn't really that we would need to sort of talk to the city firms. It was more about what the objectives were going to be on how we're going to do it. But to implement the strategy and to make markets work well, we definitely need to just consult a lot with the city on how we could do that practically. And so that part, I should have emphasized that more probably in the talk. But no, that's definitely true. Okay. And so there is there is the SRC, so we definitely spend a lot of time talking to city firms about like what's actually happening in the market and how they work. As you can't really said, make them work better unless you understand how they're working now, right? So that's the key thing. And so I would agree with that point.
We have another question from the online chat before I'll ask a question as well. But first, Nick Locke asks whether the Competition Market Authority could be provide a good regulatory oversight for market effectiveness. Whether that would be a good entity.
Yeah, so the CMA, so should I repeat that question? And so the question is, does the CMA, the Competition and Markets Authority, would they be a good, suitable effectiveness regulator? So maybe I hadn't actually thought about that, but they don't really have a lot of financial sector expertise now because they've sort of delegated a lot of that to the FCA, and so but maybe if they would go in that direction, maybe they would be a good place. Yeah, so it's something to think about. I haven't thought about that yet. So that's a suggestion I will ponder more in the future.
I have a question myself as well.
Okay.
Maybe one step earlier in the reasoning. Because how I saw regulatory intervention in the financial markets is that it's addressing externalities and market failures. And in some sense, private parties actually have the right incentives to allocate projects efficiently, apart from when there are externalities, when there is financial stability or we need to protect consumers. So that's where we have regulators in place. So I'm wondering whether if we put market effectiveness as a regulatory goal rather than sort of addressing it like the sort of failures of the market, are you actually implying that the market itself is not sort of that the regulator actually have better incentives than private parties outside of the sort of externalities issues where indeed they have a bargaining power over consumers? Yes, they can externalize systemic risk, etc. I'm just thinking about the fundamentals here of how you place yourself in that debate.
So I agree. So your perspective is correct. So so the reason markets are not effective now is because there are these externalities. Right? Yeah. And so firms don't have the right incentives. Markets themselves don't have the right incentives to design ideal disclosure arrangements because those create because if you improve disclosure, you benefit yourself a bit, but you also benefit other people. Right? So you don't take into account the external effects of your sort of actions when markets are like designing their own sort of disclosure regimes or something, or their own investment protection regimes. So think about sort of how stock markets run before regulation. They didn't really converge upon the optimal set of rules because they would think about themselves as a private entity, and then they would sort of trade off kind of what's good for the overall economy and what's good for their own members. Right? Those were not perfectly aligned, and so they would tend to maximize the benefits for their own members, at the expense of the broader economy. Right? And so one of the points of regulation is to sort of think about when you're looking at an exchange or trading arrangements, to try and focus on the sort of impact on the broader economy rather than just on the narrow economic profits of the market participants. Right? And so because those externalities are there, the market by itself will not arrive at the right set of rules. Right? So that's why you need to step in with regulation. Right? So it is so I agree with you. So there's definitely a sort of market failure that happens, and that's creates a scope for regulation to come in and improve market effectiveness.
It's better to focus on that general goal rather than just, because I agree with you that we need to focus more on outcome, etc. And
Yeah,
just sort of in a more global, like a more sort of overall perspective. But I'm wondering whether changing the overarching goal of a specific regulator to market effectiveness is not too much. Like, what shouldn't they just be addressing
Oh.
market externalities and then be outcome oriented and
okay,
a little
yeah.
bit more tailored within that? Because I would think that private actors outside of externalities and market failures will be better placed than regulators to decide how to allocate the supply and
Yeah, it's more that, so it's more that, so sometimes you say, right, so if you say, oh, the objective should be to fix market failures, right?
Yeah.
So how's that different than what I'm saying? I guess so in some sense it'd be,
Yeah.
that this is the market failure this is like prioritizing. This is just like the most important set of market failures are these, right? And so that's the one that's how you should, and if you give, so you don't want, if you give regulators too much scope, then they'll start doing, they'll further away their activities on. Right? So you say, this is what you're trying to do, right? And so go do that, right? That's basically it. So it is, so fundamentally, there is a market failure that market failures that we're trying to fix.
Mhm.
Yeah, I say, so that part that's true. So, yeah, there's this great paper, I don't know if you've seen it, by Scott Piron on the self-regulation of commodities markets. And as to why commodities markets do not by themselves have the right set of rules will not converge upon the right set of rules. It's a really brilliant paper. And so, so.
Are there any more questions? Yes.
And my second question is about the first part of your presentation, which is the choice between the city and the industry approach. What your stance you have taken, like towards the industry approach, is this a country specific, like UK specific, like stance you're taking, or like is it implementable on developing countries, for example, or would it require a country specific analysis before we take the industry approach when trying to ameliorate the market effectiveness of a like specific country?
So I think the idea works everywhere, but I guess what you would actually try to do in each country will depend on how exactly the financial markets work in each country, I guess. But I think the overall approach is that you should really think about maximizing the effectiveness of the financial markets. I think that would work in developing countries as well as here, as well. So that's one thing I'm going to try to experiment with over the next, So our research is focused just on the US so far, because we have this data going back to 18, we have like 170 years of data, which you don't have for anywhere else. But the next step is going to be try to sort of analytically look at a broader range of countries to see if the same thing is happening. I think it's going to work. And so I think that in general, I would say financial regulators should really focus on getting the markets to work well, right? And then, but exactly what you have to do in each country will differ depending on how the markets are working. So, yeah. But that's it. That's next on our agenda, is to do research on.
Is there any final really urgent questions?
You have my, if you think of something else, you have my email address, and so you can send me an email.
That's all. I thank Kevin for this amazing talk. Let's do it in real life.
Yeah, it was a pleasant actually, talking to people in person. It's quite a change.
Human interaction.
Yeah,
Brings
man.
that to
Yeah, it's like
the
weird.
central,
Yeah.
Anyway, thanks a lot.
Yeah, thank you.